All right, let's kick things off with a quick question for you. Take a look at these two lines on your screen. Which one do you think is bigger? Just go with your gut. You probably have an answer in your head already, right? Well, what if I told you they're actually the exact same length? It's a classic optical illusion. And it's a perfect example of how our minds can make these snap judgments that feel so right, but are actually wrong. And that's exactly why we're starting here. Because the stock market, believe me, is just as brilliant at playing tricks on your mind. Welcome to The Explainer. Over the next few minutes, we're going to demystify the stock market. Forget all the confusing jargon, forget the scary headlines. Our goal here is to give you the basic building blocks so you can really understand what it is, how it all works, and, maybe most importantly, where you might fit into the picture. Okay, so to really get this, we've got to go right back to the start. How does a simple business idea, let's say a hugely popular street food stall, how does that grow into a company that millions of people can actually own a piece of? Let's follow that journey. So, first things first, what even is a stock? It's really just a share of ownership in a company. Imagine a company is a giant pizza. Buying one stock means you're buying one tiny slice of that pizza. You are now, officially, a part owner. And if that pizza business gets more and more successful, guess what? Your slice becomes worth more. Really, it's that straightforward. So how does a company start selling off those pizza slices, so to speak? Well, let's tell a story. Imagine you start a pani puri corner with a secret recipe that's a massive hit. Soon, you need a bigger shop. That's when an angel investor might come along and give you cash in exchange for, say, a 10% piece of your business. Now you're a success across the city, and you want to go national. That takes millions. This is where venture capitalists come in, investing huge sums for an even bigger piece of the pie. And finally, you're ready to take over the world. For that, you need massive, massive funding. So you turn to the public, offering tiny slices of your company to millions of people. That final step, going to the public for the very first time, it has a special name, the initial public offering, or IPO. This is the moment our private pani puri empire becomes a public company, with its shares available for anyone, you, me, anyone, to buy and sell on the stock market. So, the company's now public. Its shares are out there. If you decide to buy in, this is where you face a fundamental choice. You can follow one of two very different paths with two completely different mindsets. The big question is, are you an investor or are you a trader? Think of it like this. An investor is running a marathon. They buy a piece of a company because they believe in its long-term future. They're aiming to build wealth slowly, patiently, over years. The trader's a sprinter. They might buy and sell a stock within a single day, sometimes even within minutes. They're not really betting on the company's 10-year plan. They're betting on where the price is going to move in the next few moments. Traders also often use something called leverage, which is basically borrowed money to make bigger bets. Now, this can amplify their profits, sure, but, and this is a big but, it can just as easily amplify their losses, making it a much, much riskier game. For that marathon runner, the investor, the most powerful tool in their arsenal isn't trying to time the market perfectly. It's time in the market. And this is all thanks to a concept so powerful it's been called the eighth wonder of the world, compounding. And to understand the magic of compounding, all you really need to remember is this one number, 72. It sounds random, I know, but this number is the key to a brilliant mental shortcut called the Rule of 72. And it's an incredibly simple way to figure out roughly how long it'll take to double your money. Okay, check this out. It's super simple. You just divide 72 by your annual rate of return. So if your investment grows at 8% a year, it'll take about 9 years to double. But here's where it gets crazy. Look at the difference a few percentage points make. Get a 12% return, and suddenly you've doubled your money in only 6 years. And at 15%, you're looking at just under 5 years. That is the power of compounding right there. Small changes in the return rate can have a massive impact on how fast your wealth can grow. So you can be an investor or a trader. You can pick your path. But here's the thing. No matter which one you choose, your biggest opponent is very often the same. It's the one looking back at you in the mirror. It's your own brain. let's talk about the psychological traps that are just waiting to mess with your decisions. All right, trap number one we all need to watch out for is called the sunk cost fallacy. This is that stubborn little voice in our head that tells us to keep pouring time, money, or effort into something just because we've already invested in it, even when it's clearly a bad idea to continue. We've all been here, right? You pay 500 rupees for a meal at a restaurant. You take the first bite, and it's just awful. What do? Most of us, we force ourselves to eat it. We think, well, I paid for it, so I have to finish it. But think about it. That money is already gone. It's a sunk cost. Forcing down bad food won't get your money back. It's just going to give you a stomachache. The logical thing to do is to stop eating. But our brain just hates the feeling of wasting what we've already spent. Now, apply that exact same thinking to the stock market. I want you to be honest with yourself for a second. Are you holding onto a stock that's losing money, telling yourself it has to come back up simply because you put money into it? Are you forcing yourself to finish that bad meal? It's the exact same psychological trap at play. And this trap is supercharged by another powerful bias, loss aversion. Get this. Research shows that the psychological pain of losing money feels about 2 to 3 times stronger than the pleasure of an equal gain. This means losing 1,000 rupees hurts way more than gaining 1,000 rupees feels good. And that fear makes us do irrational things. It's why people often sell their winning stocks way too early just to lock in a small profit, but hold on to their losers for way, way too long because admitting the loss and clicking that sell button is just too painful. All right, we've talked about the basics, the 2 main paths, and the mental monsters to watch out for. So, what's next? How do you actually, practically, get started? Let's get into the essentials. It's probably more straightforward than you think. You really only need 3 things. First, you need a bank account. That's where your money comes from. Second, you need your PAN card. That's for your identity and for tax purposes. And third, you need to open something called a demat and trading account, which are almost always offered together by brokerage firms. The best way to think about this is your demat account is like a bank account, but it holds your stocks instead of your money. It's basically a digital locker where your shares are kept safe. The trading account is the thing you use to actually place the buy and sell orders in the market. Simple as that.
And there we have it. We've gone from a simple optical illusion all the way to the practical accounts you need to open. We've covered a lot of ground, so let's zoom out one last time and put it all together.
So let's do a quick recap of our journey. We started by seeing how the market can play tricks on our perception. We followed a little panty-pourry stall on its big journey to an IPO. We talked about the difference between the investor's marathon and the trader's sprint. We learned to watch out for our own brain and sneaky risks like the sunk cost fallacy, and we wrapped it up with the 3 essential accounts you need to get in the game.
In the end, the stock market is more than just charts and flashing numbers. It's a powerful tool, a tool for building businesses and potentially for creating wealth. It has risks, absolutely, both in the market itself and in your own mind. But now you have a foundational map. You understand the landscape. The only question left is, how will you choose to use this tool? Thanks for watching The Explainer.